How's it going, everyone? Today we're going to take a look at the OG cryptocurrency that started all of this. Once known as a digital cash, now it's looked at as a storage of value. I'm talking Bitcoin. My name is Sugar, and this is Token Tutorials.
All right, so just like with our Ethereum deep dive video, we're going to use the Binance Academy because they just do a really good job of spelling out everything you need to know about the fundamentals and the basics of each coin. They do a really good job with their Bitcoin article, so we're going to reference that for the first portion of the video. Once we get through this, we'll go over to CoinMarketCap and look over some of the tokenomics and the metrics. And finally, we will head over to Coinbase and I'll show you guys how to actually purchase Bitcoin. So what exactly is Bitcoin? Bitcoin started as a form of digital cash with no central bank controlling it, run by thousands of computers that anyone can participate in. It was the first cryptocurrency, originally announced in 2008. A lot of people think as a result of the US financial crisis, and officially launched in 2009. It gives users the ability to send and receive digital money in the form of Bitcoin. So what is Bitcoin used for? It can be thought of a lot like cash, just with a digital presence. That means it can be transferred globally almost instantly with incredibly low fees, which is a lot better than the traditional finance system that we have in place. What makes Bitcoin valuable? Well, Bitcoin is decentralized, censorship resistant, secure, and borderless. A lot of people choose to not spend their Bitcoin. Instead, they hold it for the long term. This is also known as hodling. The theory behind this is that Bitcoin has evolved out of the phase of being a digital cash and has become digital gold. This is due to the finite supply of its design, giving it a deflationary value, which is opposite of fiat currency like the US dollar, which is inflationary, meaning that it decreases in value as time goes on. Bitcoin increases in value as time goes on, just simply because no new coins can be created. At any time, the Fed can choose to print more dollars. This isn't the case with Bitcoin. For this reason, a lot of people are now classifying Bitcoin as a storage of value. So how exactly does Bitcoin work? Essentially, it's not like sending traditional funds. You're more or less sending an IOU on a sheet of paper. That sheet of paper is a particular kind of database called a blockchain. All the participants of the blockchain have an identical copy of it, and it synchronizes with each other as new information is added. In order to add the new information, though, Bitcoin uses a special mechanism called mining. And we'll get into the whole mining thing in a bit. So what is the blockchain? The blockchain is that sheet of paper that we actually write those IOUs on. It can be also thought of as the ledger, and it's an append-only sheet, meaning data can only be added to it. Is Bitcoin legal? Yeah, it's perfectly legal in every country, and in fact, some countries are even adopting it as a national form of currency. The original creator of Bitcoin used the pseudonym Satoshi Nakamoto as his online username when he published the white paper, and he disappeared in 2010. There's been a lot of people that have claimed to be Satoshi over the years, but no one really knows exactly who he is or she. Or if it's a single person. It could be a group of people. It's kind of a mystery. So did Satoshi invent blockchain technology? He actually didn't. The use of unalterable data structures like this can be traced back to the early 90s with Stuart Haber and W. Scott Sodernetta. I'm probably butchering those names, but they proposed a system for timestamping documents very similar to blockchains of today. Before Bitcoin, there was a couple attempts at having a digital cash. However, they failed because they weren't able to actually either gain adoption or funding. DigiCash was funded in the late 1980s and it went bankrupt shortly after conception. B-Money came in the 1990s. and they actually proposed proof of work, which is the mining system that Bitcoin operates on. And they also used a distributed database where users sign transactions, which is very similar to the blockchain ledger used in Bitcoin. Ultimately, B-Money never took off as it never made it past the draft stage. BitGold consists of a ledger that records strings of data originating from a proof of work operation that was also never further developed. Going into chapter 2 of the Binance Academy article on Bitcoin, where do Bitcoins come from? This is going to talk about the mining aspect of Bitcoin, and it's definitely an important subject to know. Bitcoin has a finite supply, meaning that once all of the Bitcoins are created, no new ones can be added to the blockchain. However, not all of the Bitcoins have been created so far. The process to create new Bitcoins and introduce it into the market is called mining. Bitcoin has a max supply of 21 million coins, and currently just around 90% of them have been generated to date, but it's going to take over 100 years to mine the remaining ones. Periodic events known as the halvings reduce the mining reward, or how easy it is to obtain Bitcoin as a result of the mining process. This is because periodic events known as the halving increase the mining difficulty and also decrease the mining reward. We'll get into the halvings in a little bit. So how does mining work? Participants add blocks to the blockchain, and essentially they do so by dedicating computing power to solving a very tough puzzle. This puzzle is really hard to solve, and so it's expensive to generate a new block. The thing is, though, is it's cheap to check if the puzzle is correct once it's out there. So if someone tries to cheat with an invalid block, the network will immediately reject it, and the miner will be unable to recoup the cost of mining. Because it's so expensive to mine due to electricity costs, this kind of prevents trying to cheat within the system. Now, the reward is called the block reward, and it's what miners get when they actually solve that puzzle. It consists of fees attached to the transaction, and as well as the block subsidy. The block subsidy is how these new fresh Bitcoins are actually minted and brought to market. It essentially adds a set amount of coins to the total supply on every single reward. So how long does it take to mine a new block? The protocol adjusts the difficulty of mining so that it takes approximately 10 minutes to mine a new block. Moving into chapter 3, getting started with Bitcoin. This is going to cover how you can buy Bitcoin, a little bit about what happens if you send it to the wrong address, and how to store Bitcoin. So essentially how to buy Bitcoin, we'll go over this at the end of the article, but the main way you buy it is just through an exchange. It's incredibly easy in 2021. There's a variety of apps you can download on your phone or websites you can go to on the computer that allow you to either directly hook up your bank account or just use a credit card or debit card to purchase Bitcoin. Now, once you have Bitcoin, what can you buy with it? Currently, it's kind of difficult to buy stuff with Bitcoin in person. We're starting to see Bitcoin ATMs and a few Bitcoin related services pop up here and there, but it's kind of far and few between. However, online, there's a ton of websites that you can find that accept Bitcoin as a form of currency. And Binance just lists a few ideas of things you can buy with Bitcoin. A lot of them being travel related, with airplane tickets, hotel rooms, real estate, food and drink, clothing, gift cards, and online subscriptions. You can really buy pretty much anything nowadays with Bitcoin online. They talk a little bit on places you can spend Bitcoin at, and we're not going to go over that. Now, because there's no bank involved with Bitcoin and it's all decentralized, you are responsible for keeping your coins secure. When you make a transaction, it can't be undone. Once that page is written to the blockchain, it can't be rewritten. So always double and triple check the addresses that you're sending to or requesting from when using Bitcoin. If you send Bitcoin to the wrong address, it will be gone forever. This is another reason why Bitcoin is so deflationary. Not only does it have a maximum supply on the amount of Bitcoin that can be minted or mined, but if Bitcoin's lost in a transaction or transfer, it can never be recovered. In reality, we have a good idea of how many coins have been mined, but we don't know how many coins are actually in circulation because we don't know how many people have accidentally sent Bitcoin to the wrong address. Now we can use on-chain metrics to get a good idea of this, which is a advanced way of basically reading the blockchain to decipher metrics, kind of like if you were looking at a stock chart. You can actually use the blockchain ledger to do this same kind of thing. If you know which wallets are sending how much Bitcoin to who, you kind of get an idea of what's going on in the trading world. This is why when it comes to actually trading Bitcoin, it becomes a lot more interesting than normal stocks, because we can still use normal charting and indicators that we got from the stock market and technical analysis from the stock market. We can use those theories for trading cryptocurrency and Bitcoin, but we can also see who's sending into what accounts. So we can see if smaller wallets, maybe customers like me and you, are buying or selling at a specific time, and who we are buying and selling to. If big investors are on the other end of our orders, or if it's other retail. Now that plays a big role in helping to determine possible trends and trade setups, but I won't get into that because this is more of just a deep dive in history video and not an actual trading strategy video. I'll have one of those in the future, as well as a controversial video that I have planned on my personal take on Bitcoin. I'm trying the hardest that I can to keep my personal bias out of this video and stick with just the facts as Binance Academy puts it out there. I will say, I used to love Bitcoin. In 2014, I remember going to my parents. It was the year I graduated high school, saying I wanted to put $100 of my savings account into Bitcoin, and they laughed at me, said I was dumb, and I never invested into it. Had I invested that $100 then, I would have had north of $23 million today. I kind of regret that, but what are you going to do? Fast forward to 2021, there was a time that I was trading Bitcoin for a little bit and made some money off Bitcoin. Also lost some money trading it, but I learned a lot of lessons on it, and I gained kind of a unique perspective on the use case of Bitcoin. But that's going to be for a later video. Just wanted to tease that for you guys right now. Let's get back to this. How can we make money with Bitcoin? Well, we kind of briefly touched on that with the trading strategies, but long-term investors can buy and hold Bitcoin, and they do so believing it's going to rise in value. This is kind of taking that storage of value approach with it. Others choose to actively trade Bitcoin against other cryptocurrencies or the US dollar to make short and mid-term profits. You can also make money with Bitcoin in a third way, and that is by lending your coins to someone else. This is something that we've seen brought on because of the DeFi movement. Platforms like Voyager Interest are a great way to do so. By simply storing a minimum amount of Bitcoin on the Voyager platform for 1 month, you can earn a 5% interest payment or more on it. It changes from month to month, so you'll have to check the Voyager Interest program's interest sheet, but I highly recommend checking that out if you are looking at holding Bitcoin for the long run, because if you're going to be holding it, might as well earn interest on it on top of it. There's a link in the description to my Voyager sign up code, and by using it, you and I will both benefit by getting some free crypto. When it comes to storing Bitcoin, there's two main ways to do so. The first is a custodial solution, which is essentially trusting a third party to do so. This is mainly done with exchanges and can be seen by holding your coins on a platform like Binance or Coinbase or even Voyager. The nice thing about doing this is it allows you to have easy access for them for trading or lending. Now the downside to this is you don't actually own your coins. You're trusting them with that third party. So in the event of a hack, you could lose everything and they could just be like, yeah, not my problem. We've seen this with Mt. Gox a couple years ago. On the other hand, what you can do is store your Bitcoin in a non-custodial solution. And there's two ways of doing that. A hot wallet is basically a wallet on an app that connects to the internet. You can do so by downloading it on your phone or installing a browser extension. The most popular one is Trust Wallet. I personally highly recommend Trust Wallet. You can also use MetaMask, which we can see right here. MetaMask is a Chrome extension. It's super easy to download, super easy to use, and you can actually merge the two together, Trust Wallet and MetaMask. The second non-custodial option is cold wallets, and these are wallets that are not exposed to the internet. They basically are like USB devices or hard drives that you can plug in to your computer and store your crypto on. Both hot wallets and cold wallets are great ways of owning your own crypto. Now, when it comes to these wallets, you're going to get two types of keys. A public key that's meant for sharing to the public. It's how you're going to be able to tell people, hey, send me some Bitcoin to this address, and they'll be able to send you your Bitcoin. Think of it as almost like your username or your email address. You'll also get your private key. These are keys that you're never going to want to share with anyone, and these can be thought of like a password. You're going to want to physically write these down by hand. Do not take pictures of it, and do not type it and save it to your computer. In event of a hack, a hacker can find these keys and get access to your portfolio and steal everything. Me personally, I've actually written them down on a piece of paper, and I store them in a fireproof safe. I don't want anyone getting access to my private keys, and they're also going to be safe in the very unfortunate or unlikely event of a fire. I highly recommend you do this, and it's a very important safety measure. You don't even need to go as far as using a full gun safe. You can go to Walmart and get a $20 pocket safe, a small Century 6x6 safe. Doesn't have to be big. I mean, we're just folding up some pieces of paper to put in there. And it costs about $20, $25, and I think they got like a 3 to 4 hour fire rating time on it. These little measures go a long way in security, and it's something that's very important if you're going to have large sums of your money or your net worth in these assets. Now, Chapter 4 goes over the Bitcoin halving. This kind of jumps backwards to that mining discussion that we talked about earlier. The Bitcoin halving is simply an event that reduces the block reward. Remember, the block reward is that tip and that block subsidy that miners get as a result for actually solving the puzzle that creates new blocks. And new blocks are what contain that data that we write to the blockchain. Once that Bitcoin halving occurs, rewards given to miners for validating new blocks are divided in half. Now, this only divides the block subsidy in half. There's no impact on the transaction fees. When Bitcoin originally launched, miners were awarded 50 Bitcoin for each block they found or each puzzle they solved. In November of 2012, the first halving occurred. It went from 50 to 25 Bitcoin as the new reward. In 2016, the reward again dropped from 25 to 12.5 Bitcoin, and most recently on May 11th of 2020, it dropped down to 6.25 Bitcoin. You can see a trend developing here that it seems to occur every 4 years, and this is by design. Every 210,000 blocks, the halving occurs. Because a block takes about 10 minutes to mine, some simple math puts us at around 4 years for every single halving. Now, the halving occurs for a specific reason. Having a finite supply means that the currency is not prone to debasement in the long run. This goes back to that example we had earlier of the deflationary versus inflationary with Bitcoin versus the US dollar. With the halving mechanism, there's also an incentive to mine for an additional 100 years, giving the system plenty of time to develop adoption. Halving does have a pretty big impact, not just because the miners themselves are getting half of the rewards, but this also causes generally a sharp price rise because of the increase in scarcity. The next halving is expected to take place in 2024, and it will drop the block reward down to 3.125 Bitcoin. Chapter 5 goes over common Bitcoin misconceptions, and I really like that they put this in here. First off, Bitcoin is not anonymous. Remember that every transaction is written to the blockchain, and every participant on the blockchain has access to that data. While your identity isn't directly tied to the addresses on the blockchain, an observer with the right resources could potentially link the two together. So it's best to think of this Bitcoin as pseudo-anonymous. It's relatively private, but people can still find out who you are. Is Bitcoin a scam? No. Just because it's digital doesn't mean it's a scam, and it's not controlled by anyone, so who would be benefiting from the scam? Unfortunately, though, Bitcoin has been used in many scams, and just because it's a medium used in scams doesn't mean it is a scam. I mean, keep in mind, the US dollar has been used for how many years in scams? So does that make the US dollar a scam? The same thing is true when people say, is Bitcoin only used for drugs or crime? Well, let's keep in mind the most commonly used form of currency for drugs and crime is the US dollar. And keep in mind, Bitcoin is pseudo-anonymous and every transaction is logged. If I hand $1 to the clerk at the grocery store and they hand me change back, I have no way of knowing the person who originally had that dollar before me. But with Bitcoin, you can kind of track all that with the ledger. So why would you want to use that for crime? Not to mention, we have dedicated privacy coins in 2021, i.e. Monero, that is dedicated and purposely put out there to be a private transaction network. Why wouldn't you just use Monero? I don't know, it just doesn't make sense to me to use Bitcoin for crime purposes. There's just a lot better means to do so, like the US dollar. So that brings us to, is Bitcoin a bubble? This article doesn't really do a great job at explaining it. It kind of skirts around the fact, but I mean, it's really hard to prove if something's a bubble until that bubble actually pops and you have historical data to prove that. Up until now, we don't have that historical data. Bitcoin's just too new to the market when it comes to longer term investments. With the stock market, we have hundreds of years of data to refer back to. With Bitcoin, we've got 2009, 2010. I mean, really, it didn't start gaining enough volume for accurate data recording until 2011, 2012. So we only have like 10 years of price data to base all this off of. And all of that data is speculation in the free market anyways, so it's so hard to tell if Bitcoin's in a bubble just simply because it's not been around long enough. Now, because it hasn't been around long enough, this just brings volatility to it by nature. This volatility often results in very high rewards to the users in the end, though. We can see that going back to my example of if I would have spent that $100 back in 2014 buying some Bitcoin, I could have been a millionaire and wouldn't be having to make some videos for you guys right now. But anyways, let's get back to this myth. Does Bitcoin use encryption? No, it uses digital signatures and hash functions, which is similar but not even close. It's important to note some crypto wallets out there, mainly hot wallets and cold storage, do use encryption, but it has nothing to do with the blockchain. Going back to the basics of the blockchain, let's take a look at some scalability, because in order for Bitcoin to reach mainstream use, it has to scale up first. Now, scalability is the measure of a system's ability to grow and accommodate increasing demand. Obviously, in order to become mainstream, it's going to have to scale. So going over why it needs to scale. To function in day-to-day payments, Bitcoin must be fast, which it is currently not. Remember, there's only a few transactions that can be processed per block. Now, miners are going to prioritize transactions with higher fees first because it takes a lot of money. Why would they take a lower fee offer when they can earn a higher fee offer? This kind of clogs up and can create a waiting room, as we see here. Ultimately, approximately 5 transactions per second can happen on the Bitcoin network, which is slower than traditional payments, and it's very slow compared to other cryptocurrencies out there now. This is where we introduce the Lightning Network, and this is a proposed scalability solution for Bitcoin. The Lightning Network is a layer 2 solution, meaning it moves transactions off the blockchain and onto a new blockchain, so that way it just reduces clutter. It allows users to send funds near instantly and for free with no constraints on throughput. Participants lock up some of their coins in a special address beforehand, and it releases Bitcoin if both parties agree on both sides of the transaction. The parties keep a private ledger that they can reallocate balances without announcing that to the main chain, and it only publishes the transaction history to the blockchain when the actual transaction is done and complete. Once it's done and complete, the protocol then updates the balances of both the wallets accordingly. The article then goes into talking about what are forks. Bitcoin is open source, meaning that anyone can modify it if they want. A fork can happen in two different ways, and essentially a fork is basically a way of changing the blockchain. Think of it as the road separating and going in two different ways. A soft fork is a change to the rules that allows updated nodes to interact with old ones. Essentially, it's just like a reboot or a software refresh on your phone. The old coin is still intact and the old blockchain is still intact. There's just new rules that the nodes follow. SegWit is an example of a soft fork that Bitcoin saw, and it introduced a new format for blocks and transactions. Now, hard forks are a different, more controversial and a little bit messier way of splitting the blockchain in two. It actually splits in two with a hard fork. This causes two completely different protocols and therefore results in two completely different currencies or coins forming as a result. We saw this happen in 2017 when Bitcoin went through its hard fork. Part of the participants of the Bitcoin network wanted to increase the block size to ensure more throughput and cheaper transaction fees, while the other thought this would be a very poor scaling strategy. What eventually happened was a hard fork took place and gave birth to Bitcoin Cash, which is where the hard fork split. Bitcoin went one way and Bitcoin Cash went the other way. Chapter 7 goes into participating in the Bitcoin network, and this is going to be mainly when it comes to running a node. Now, a Bitcoin node is the program that actually interacts with the Bitcoin network in any way. There's a couple different types of nodes. We have full nodes, which validate transaction and blocks if they meet certain requirements, and they are integral to Bitcoin's decentralization aspect. Now, light nodes are not as capable as full nodes, but they're also less resource intensive. They allow users to interface with the network without performing all the operations that a full node does. Light nodes only need to download a portion of each block known as a block header and not the full entire block. This is ideal for devices with constraints in bandwidth or space and often used in desktop and mobile wallets. The third type of node is mining nodes, and these are full nodes that perform the additional duty of producing blocks through mining. They take pending transactions and hash them along with other information to generate a block number. Now, essentially, your light nodes, these can be like your Trust wallet, your MetaMask. Full nodes, these are generally your exchanges. They're going to be the actual big senders back and forth, and your mining nodes are obviously the creator nodes. The article then goes into talk about how to run a full Bitcoin node as well as how to mine Bitcoin through running a full node. Keep in mind, in order to mine Bitcoin, you first have to have that full node set up. I don't want to spend too much time covering how to mine Bitcoin because it is so incredibly resource intensive to mine Bitcoin that it's not very profitable unless you're a multi-million-dollar company that has warehouses of miners set up. The competition is just so steep, and there's a lot better coins that you can mine or just stake your coins in through DeFi that mining Bitcoin is kind of a lost cause for the small guys like us. But let's just touch on it real quick so you guys get an idea of how the mining works. In the early days of Bitcoin, it was possible to create new blocks with conventional laptops, but as it grew, application-specific integrated circuits, abbreviated ASICs or ASICs, were developed in order to specifically address the purpose of mining Bitcoin. These are specialized computers that are incredibly expensive and are operated by very, very knowledgeable technicians, and they're designed to only mine Bitcoin. It requires a significant investment not only in hardware but also energy. We currently see large Bitcoin mining facilities being built near power facilities. That's just how resource intensive these can become. The article then closes by saying who can contribute to the Bitcoin code. Because Bitcoin is open source, literally anyone that's got some tech savviness can propose new features to be added. They can report bugs, or they can translate and improve documentation. It's all an open source group effort to improve Bitcoin. So if you think you're up for the task, definitely check out some of the Bitcoin blog posts or the Bitcoin Core website. But for now, we're going to head over to CoinMarketCap and take a look at some of the tokenomics and some of the metrics behind Bitcoin before diving into how to purchase Bitcoin. So CoinMarketCap is one of my favorite websites when it comes to getting statistics on coins. We can see here Bitcoin is the number one coin on the market. Obviously, it is the oldest and it is the most widely known coin. As of July 3rd, 2021, we are trading at just over $34,560, and we are up 3% on the day. Not bad for those holders out there. Bitcoin has a market cap of $648 trillion with a fully diluted market cap of $725 trillion. It's had a 24-hour volume of $24 trillion, and currently the circulating supply is sitting at 18,747,243 Bitcoin, which is roughly 89% of the total supply. We can see, as earlier stated, the max supply is 21,000, and there's our total supply. That's how we get to our 89% number. And scrolling down to get a little bit more information here. Currently, Bitcoin has a market dominance of 45.29%. Bitcoin's all-time high was placed on April 14th, and it was $64,863. A lot of people say that that is nowhere near close to the potential all-time high of Bitcoin. I've seen realistic price estimates of $100,000 to $200,000 in the next year to year and a half, and I've seen some crazy estimates upwards of $1 million. Me personally, I can see more of that $80,000 to $100,000 definitely being a possibility. But as we can see, Bitcoin's all-time return on investment has been just over 25,000% ROI, which is just absolutely insane. And at the bottom here, we can see these are the Bitcoin markets listed on CoinMarketCap. This is basically their way of showing the 6 most popular places to get Bitcoin in their trading pairs. So the most popular place being Binance using USDT. We can also see Binance coin being used here at the number 3 spot, and ETH being used at the number 5 spot. All of those being Binance. The other exchange here that I also highly recommend is Coinbase. Both Binance or Coinbase are great exchanges, but you can't go wrong with any of the 4 that you see here. For purposes of this video, we're going to head over to Coinbase, and I'll show you guys how to buy Bitcoin. The first thing you're going to want to do is log into your Coinbase account. If you don't have an account, make sure to use the link in our description. It will give you some free Bitcoin if you put in a minimum deposit, and it also helps support the channel. If you already have an account, you will have to use your phone for the Authenticator app. You will have to do that every time. It's a pain in the ass, but 2-factor authentication is important, as is safety when it comes to everything with crypto. Always keep your passwords and private keys written down. Don't use the same password for exchanges. In fact, just button smash the shit out of your keyboard for your password. Make sure to write it down and make visible beforehand, but my passwords are like 40 characters long and they're just random stuff. I have to refer and open up my safe every time that I log into a lot of these things, because there's no way I will remember any of them, let alone the 20 different exchanges and wallets that I have. But back to the video. If you are looking to buy Bitcoin, now is the perfect time. We are trading at $34,500. I will say I'm not a huge Bitcoin fan overall, and I won't get into that on this video alone. But I still think that because Bitcoin is kind of that market leader, the whole entire market kind of follows Bitcoin prices, that at this point in time, you almost have to own some Bitcoin. It's still in that financially irresponsible to not own Bitcoin phase. However, I don't know if that's going to be the case long term. But anyways, if you're looking to buy some Bitcoin, all you have to do is hit this trade button. It is that easy. It will bring up this screen here where you can either buy, sell, or convert different coins. This is linked to your bank account. You can see here, pay with Chase, or I can open it up and add a new debit card. Whichever way you want to do is up to you, but it is stupid easy. You just type in how much you want to buy and you hit preview buy and you buy it. I'm not going to buy it because I'm not looking to buy Bitcoin right now, but that's how you do it. Say you have some stable coin in your account. Me personally, I got some DAI sitting. It kind of acts as a savings account, but I get 10 times more interest on it a year than my Chase high yield savings account. So for a coin that only trades at $1, it kind of just makes sense. Say I wanted to convert some of my DAI to Bitcoin. We will just transfer this over to that. And you can put in how much you want to buy. It will do the calculations for you. We can preview the order, and if we wanted to actually go through with this, we could convert it. I am not going to though. But as you can see, it literally takes 2 seconds to buy Bitcoin. It is stupid easy. Once you have the Bitcoin in your wallet, it's recommended to transfer it off of exchanges if you're going to be holding it for the long term onto either a cold storage wallet or a hot storage solution like Trust or MetaMask. And I'll have a video in the near future on how to do that. There's nothing wrong with holding your Bitcoin or long holds on an exchange. The only problem is you open yourself up to risk of a hack. Now, the benefit to keeping it on an exchange is for those looking to actively trade their crypto. It's going to be able to give you that liquidity and that means of connecting with the exchange directly, so you can just put that sell order in and sell it right away. If you were to transfer your crypto off of the exchange and onto something like a Trust wallet, if I wanted to sell, I would then have to transfer it back onto the exchange, and that transfer takes some time. If the price is falling incredibly fast and I need to get out of the position instantly, that can't be done if that crypto is stored on a cold storage or a software storage like MetaMask or Trust. That's why I opt to keep a portion of my crypto on exchanges and another portion on the cold storage wallets. But that pretty much wraps it up for the deep dive on Bitcoin. We use the Binance Academy to go over the background basics, creation, and mining of Bitcoin. We talked a little bit about the storage of Bitcoin. After that, we headed over to CoinMarketCap and took a look at some of the tokenomics and some of the metrics. And finally, we took a look at how to purchase Bitcoin using Coinbase. If you have any questions, make sure to put them down in the comments and I'll make sure to get to it right away. If you enjoyed today's video, make sure to give it a thumbs up. And if you want to see more content like this, make sure to hit that subscribe button. I plan on doing a deep dive video like this for a majority of my favorite long hold coins every day or two. The next video is going to be about the basics of DeFi as a whole, and it's going to talk about the DeFi sector. With that being said, my name is Sugar. I hope you enjoyed today's video. Remember, this is not financial advice. This is only for learning purposes. Always consult a professional financial advisor before making a trade, and always do your own research before entering trades. With that being said, have a good one and trade safe.